This is Nightly Business Report with Sue Herrera and Bill Griffin.
Rolling along, the Dow soars more than 300 points to close back above 25,000, just as some say they see turbulence on the horizon.
Hang on tight. Home prices could rise at twice the speed of inflation and pay. And some say that is not sustainable.
Skills gap. Companies cannot find the right workers, but a program in Louisville, Kentucky may have found a solution in high schools. Those stories and much more tonight on Nightly Business Report for this Wednesday, June the 6th.
Good evening, everyone, and welcome. A midweek surprise on Wall Street. Stocks surged thanks to a rally in the banking sector. Names like J.P. Morgan, Goldman Sachs, and American Express all climbed as interest rates rose and the yield on the 10-year Treasury inched all that much closer to 3%. Also helping the Dow, Boeing, which closed at a record. Add to that an easing of trade concerns, at least for today, and stocks took off. The Dow Jones Industrial Average soared 346 points to 25,146, its highest close since March. The Nasdaq gained 51, that's a record, and the S&P 500 added 23.
And despite the continued rise of equity prices that we're seeing, one longtime market watcher says he has started selling stocks during rallies like we saw today. That's because the chairman and CEO of Omega Advisors, Leon Cooperman, thinks that this market is now fairly valued.
I'm sympathetic to the idea that sometime in the next 12 to 24 months, there'll be events that will catch the market. I think that inflation and interest rates will catch up to the market as we normalize.
Cooperman also believes next year could be a turbulent one for the stock market as the Federal Reserve raises interest rates, and that is similar to what the world's largest hedge fund is saying right now. According to published reports, Bridgewater Associates said 2019 is setting up to be a dangerous period for the economy as the fiscal stimulus rolls off, while the impact of the Fed's tightening will be peaking.
So what could test the market in the coming months, and what should investors be watching for? Mike Santoli gives us a look at Wall Street's worry list.
Wall Street has been contending with a spate of concerns this year. Trade war fears, rising bond yields, and an oil price surge among them. Yet for now, the markets seem to have made their peace with these issues. As the broad indexes approach a three-month high, tech shares set new records, and market volatility settles near its low for the year. So what potential worries might be going unnoticed for investors as the sometimes jumpy summer trading season gets underway? Well, for one, what if Goldilocks goes missing? The past 2 months of U.S. economic data has been strong, but not too strong, which has allowed Treasury yields to pull back a bit. But this week, evidence has started to build that worker shortages and transportation bottlenecks are raising costs for businesses, which could threaten the not too hot, not too cold backdrop that usually allows stocks to thrive. Related to this concern of tight labor and resource markets, might the Federal Reserve send the message that 3 more rate hikes this year are very much on the table? In last week's flutter of market turbulence coming out of Europe, traders reduced their bets on further hikes to 1 for sure next week and perhaps another in coming months. Stock and bond prices are probably not positioned for a more aggressive Fed than that. And finally, some veteran investors are on alert for some sort of global financial mishap of the kind that often pops up later in a market cycle as central banks tighten financial conditions. Focus is landing on stress in dollar borrowings by overseas companies and governments at a time when large U.S. government deficits and the Fed shedding its bond holdings mean dollars are being pulled back home in large numbers, raising their cost abroad. There have been some hints of this kind of stress on and off this year, which bear monitoring. None of these hazards might end up arising, of course, and even if these jolts do strike, there's always the chance that stocks can absorb them thanks to sturdy corporate profits and still low interest rates. But it's when markets are comfortable and the good news is obvious that it sometimes makes sense to look for where the next scare might come from. For Nightly Business Report, I'm Mike Santoli.
So with respected investors starting to issue some market warnings, should investors start playing defense? Joining us tonight with her insights, Shannon Sakosha is Chief Investment Officer at Boston Private Wealth. Thanks for joining us tonight.
Thank you for having me.
We should say you're not all that concerned about 2019, unlike Bridgewater Associates or maybe Lee Cooperman, right?
I think that's fair. I think that one of the things that we're really thinking about and what we've been focused on is the U.S. economy. I think that whereas we had a pullback in tech prices, in the early 2000s, and then we had really the housing crisis in 2008. We're really looking for this next recession to be a more typical one, and we're not seeing U.S. economic data indicating that there's a deterioration ahead of us in 2019, certainly not 2018, and really not much for 2019 unless something changes dramatically over the next several months.
And would that change be a more aggressive Fed, perhaps, or not?
That is definitely one of the bigger threats. And I think that one of the things that we're thinking about is, as you mentioned, there are sort of 2 hikes expected this year. If we get another hike, making it 4 for this year, I think the markets would have trouble digesting that. I do think some of the events that have occurred in Europe over the last several weeks are creating some uncertainty that the Fed would accelerate even in the face of continued inflation and wage growth. So we're less concerned, I think, than we were even a month ago about an additional rate hike this year. But that is probably the one thing that could potentially lead us to a quicker recession than in sort of the 2020 timeframe.
But humor me for a moment. If we are telling people that maybe they should start thinking at least about playing defense in this market, what would be a good defensive play, do you think, equity-wise?
Well, I think if we think about sort of the traditional value stocks, those remain sort of under pressure right now. I mean, dividend yields are certainly not as attractive as they typically were from a defense perspective. You think about quality and you think about earnings. I think those are still very important to traditional investors. Technology right now, although it's experienced some great gains, there's still some very quality companies in the technology sector that make sense as more of a defensive nature. We are also in a late cycle. Cyclicals, there are some undervalued cyclicals that could make sense for clients over the course of the next 12 to 18 months.
What about the headline risk? We certainly saw it earlier last week with Italy and some of the turmoil in Europe. But also, we still have not resolved numerous trade issues that are out there.
Sue, I think that's honestly the biggest risk that we have right now for the second half of this year. I think that as long as we're continuing to see trade policy focused on small parts of the economy, areas of the economy that aren't particularly additive to GDP, I think that it's a very limited scope as far as economic impact. If we start to see a significant ramp up from our trading partners as far as tariffs go, and we start to expect there to be a lasting economic impact from the trade policy, I think that's something that could accelerate the recession that would change our view for kind of late 2019.
Shannon Sakosha with Boston Private Wealth. Thanks again for joining us tonight.
Thank you.
And to the economy now, where the trade deficit narrowed to the lowest level since September, thanks to record exports. Exports were lifted by an increase in shipments of industrial materials and also soybeans. Economists say the trade numbers point to strong economic growth in the second quarter. But as we've been reporting, economists also warn that those rising trade tensions could pose a threat to that outlook.
And it turns out that American workers were not as productive in the first quarter as originally thought. The Labor Department said this morning that the increase in productivity was only roughly half what was first reported, and that's because unit labor costs, or how much it cost to make each product, rose a bit more than expected. When productivity rises and workers increase how much they produce per hour, companies make bigger profits, and in theory, they give larger pay raises.
And now to the labor market itself, where UPS workers voted overwhelmingly to authorize a strike, which could potentially be the biggest one the country has seen in decades. 280,000 Teamster members have the option to walk out if current contract talks fail. The contract expires on July 31st. At issue is how UPS will expand to offer deliveries 7 days a week. Both sides noted, though, that the vote does not mean that a strike is imminent.
And as we reported yesterday, right now there are more job openings than there are workers to fill them. And part of the problem is that not enough workers have the skills that employers need right now. But an innovative program in Louisville, Kentucky, is attempting to close that skills gap. And as Steve Leisman reports, it starts in high school.
Here at the Oxmoor Toyota dealership in Louisville, Kentucky, a lot of the service bays are empty. Not because there aren't enough cars to fix, there aren't enough mechanics to do the fixing.
These cars are computers. They are no longer the change the oil, change the belts. They are hooked up to a diagnostic machine. You have to know how to read the codes. Sometimes you have to know how to write codes.
It's a local example of a bigger national problem. The government reports a record 6.7 million job openings, and businesses complain they can't find the skilled workers to do the jobs.
It's a high-class problem to have, but it leads to other issues. Obviously, our economy is a little bit hotter than our workforce's ability to keep up with it.
That has sparked a national debate about education. Should kids learn trades in school to fill those open jobs, or go on to get a college degree?
Not every student's going to be a college student. And there's many other opportunities and we have an aging workforce in the skilled trades area. So we've been trying to create the opportunities and let them understand this is a great field for you to look into.
The city of Louisville is addressing the question through the academies, a partnership between local businesses, the public school system, and city government that establishes trade schools in the high school system.
With traditional education, you are going to be sitting in a desk a lot. You're going to be not really getting to do a whole lot of hands-on. And I will be graduating with my EKG certification and knowing a lot more about healthcare than many people that I will be going to college with.
17,000 high schoolers of the district's 100,000 students can choose from 140 career paths, ranging from welding and manufacturing to health sciences. Manning one of the bays at the Toyota dealership, 18-year-old senior Ibrahim Nasruddin is learning a trade now, but plans to go on to get a college degree.
This is my favorite thing and doing. And also, after I finish my career in here, I'm still going to be studying for airplane engineering.
All too often in school, the curriculum hasn't changed in a century. And we know our world has changed greatly in a century. So we've got to provide kids with engaging opportunities in school that are going to make them successful in today's world once they get out. So they've got to be successful in college, but also in career, and it's our responsibility as educators to meet those needs of our students.
For Nightly Business Reports in Louisville, Kentucky, I'm Steve Leisman.
Great story. Time to take a look at some of today's upgrades and downgrades. The health insurer Cigna was upgraded to buy from neutral over at Goldman Sachs. The analyst says Cigna is positioned to continue to increase market share gains in the commercial risk market, and the price target is $212. The stock rose more than 2% to $174.93. Valiant's rating was upgraded to overweight from equal weight at Barclays. The analyst says Valiant's business has stabilized, and it points to its product pipeline. The price target is $29. The stock gained 7% to $25.41.
Manitowoc was upgraded to buy from hold at SunTrust Robinson. The analyst there says the manufacturer is positioned for growth right now, so raised the price target to $33. Shares soared by 15% as a result today to $27.45. And shares of Floor and Decor Holdings were upgraded to overweight from neutral at Piper Jaffray. The analyst sees growth ahead for the flooring retailer even as interest rates continue to rise. Price target $58. Shares of Floor and Decor Holdings gained 7.5% to $52.48.
Still ahead, what happens to the housing market if home prices rise twice as fast as wages? We'll ask an expert next.
The recent dip in interest and mortgage rates has not gone unnoticed by home buyers. Mortgage application volume rose more than 4% last week from the previous week, but that was actually lower than a year ago, and that's largely due to a drop-off in refis.
And while mortgage applications are higher, a new Reuters poll found that home prices are rising at twice the rate of inflation and wages, signaling pain ahead for potential home buyers. So when will we see conditions in the housing market normalize? We're joined tonight by Lawrence Yoon. He is the chief economist at the National Association of Realtors, and he took part in that poll. Welcome. It's nice to have you here, Mr. Yoon.
Thanks for having me on the show.
So when will we see a more normal housing market based on what you see out in the environment? I mean, it's been tight for so very long.
We need more inventory, and only way to do that is to have more construction. It could be possible if some of the real estate investors begin to unload, but there are no sign of that. So we are left with new home construction as only game in town to increase inventory. And right now it is still a sluggish pace. It's rising, but not back to historical normal. I anticipate maybe towards the end of the year, we may begin to see stoppage and decline in inventory. Now, that does not mean that we are back to normal. It just means that inventory will no longer fall. It will still be a tight market.
Why have builders not been building enough to keep up with the pace of demand? I mean, you've got supplies, I guess, that there's the rise in prices there. Not enough land, the fear that we could have another kind of a financial crisis that they have yet to recover from. What's going on here, do you think?
Well, the fear of financial crisis is misplaced. Banks are in much healthier condition. The mortgage underwriting standards are very tight. It's going to high credit score individuals, and the default rates are historically low. The condition as to why the builders are slow in recovering is partly due to the prior segment. There's just not enough skilled construction workers. Everything from wood framers, carpentry, plumbing, welders. So that is holding back some of the recovery potential. The other is that the material cost that goes into construction recently has been rising much faster than other price component. Lumber, for example, has risen 60% over the past 2 years, partly from global economic recovery, but also the tariffs adding to the cost. And small builders are not in the game because they have had hard time getting the construction loans from the community banks.
And is that increase in costs across the board why you think that that home prices will move to the upside at twice the pace of pay and wages?
So right now we are in a housing shortage. So based on the momentum factor, how much the builders can bring additional homes online over the next 2 years, it looks like we may continue to see these shortage condition. Maybe not the acute shortage of today's condition, but we have to remember, past 5 years, home prices have risen roughly 40%, while people's wages have only risen by 12%, almost 4-to-1 ratio. And that trend just simply cannot continue. It is unsustainable. And only way to moderate home price growth is to have more construction.
We will see. Thank you so much, Mr. Yoon. Appreciate it.
Thank you.
Lawrence Yoon with the National Association of Realtors.
Elsewhere, quarterly results shine at Signet Jewelers, and that is where we begin tonight's market focus. The owner of Zales and Jared reported a surprise profit helped by strong performance in the company's e-commerce business. Same-store sales were flat, but that was actually a lot better than analysts had been estimating, and it marked a big improvement from a year ago. Shares popped 18% to $52.27. Meanwhile, Athena Health CEO Jonathan Bush is stepping down from his role following recent allegations of inappropriate behavior. The company also named former GE CEO Jeff Immelt as executive chairman and said that it is considering selling itself following pressure from an activist investor hedge fund. Elliott Management launched a $7 billion unsolicited bid for that company last month. Shares of Athena Health climbed by 4% today to $157.44. And Delta Airlines said that rising fuel costs would cause profits to come in lower than expected during the current quarter. Shares of Delta were off by nearly 1% as a result today to $54.17. Sue?
Bill, United Health Group raised its dividend 20% to 90 cents a share. The health insurer also said it plans to buy back 100 million shares. Shares of United Health Group rose nearly 2% to $248.65. Jack Daniels maker Brown-Forman reported weaker than expected sales and warned that gross margins would be pressured on rising freight and raw materials costs. And due to the ongoing disputes about tariffs, Brown-Forman said that it was difficult to accurately predict future results. A portion of Brown-Forman's total sales comes from Europe, Mexico, and Canada. The shares fell 6% to $52.47. And after the bell, the discount retailer Five Below reported a rise in sales and profits, and that topped street estimates as well as its own expectations. The company also gave upbeat guidance for the current quarter and the full year and added that it's still growing and it plans to open more than 1,000 more stores across the country. The shares were initially higher in after hours. They also finished the regular session up 3% to 81.28.
Coming up, the push to give more women the roadmap to power in Silicon Valley. There are reports tonight that Fidelity Investments is planning a big push into cryptocurrencies. The investment firm is reportedly hiring developers to build a cryptocurrency exchange. According to Business Insider, such a move would represent one of the biggest moves by a Wall Street firm into the market for digital assets. Fidelity, of course, is best known for being a provider of traditional 401k and other retirement products.
Women are carrying the biggest share of the country's outstanding student loan debt. According to an education advocacy group, women own nearly $900 billion in student loans. That's nearly 2/3 of the total. Economists say it will take longer for women than men to repay their loans, potentially racking up more interest and falling deeper into debt. Women make up 56% of today's college students.
And women comprise less than 1/3 of Silicon Valley employees. Even fewer are founders of companies with financial backing from venture capitalists, and just a small number establish early stakes in startups. Well, now a group of investors is trying to close that gap, and they say it all starts with a legal document. Julia Borston has our story tonight.
Seema Sistani became COO of video chat platform House Party while pregnant with her second child.
There's a prototype here of the startup founder being white, single, young male, and who's dedicating their entire life subsisting on ramen noodles to build an empire. And unfortunately, that didn't look like me.
She was convinced by angel investor Chloe Sladden to leave an executive job at Yahoo's Tumblr to co-found House Party, a big risk in exchange for potentially big upside, a chunk of shares on the company's cap table.
The cap table is the legal document that records who's going to make money when a successful startup exits. The cap table is more than a legal document, though. It is the roadmap to power in Silicon Valley, because the wealth that is created from the cap table funds the next generations of startups.
Sladden's investing collective, called #Angels, is focused on getting startups to allocate more shares to women. The Angels have invested in more than 60 companies over the last 3 years, working with the founders to explain the upside they'll have in attracting top talent if they offer more shares to female hires. The Angels host dozens of events to discuss the cap table gap and coach women to push for more shares.
When you're negotiating for equity, there's no real roadmap to understand how you can value the equity, how much growth a company is going to have. And so if we think that in general, it's been harder for women and underrepresented minorities to even negotiate as well for the equity.
The Angels draw on their network to help place women in senior roles at early stage startups. They partner with venture capital investors, including Sequoia and Kleiner Perkins. First Round Capital's Finn Barnes has collaborated with the Angels on an investing boot camp and on a number of deals.
Their networks tended to be majority female and equally amazing to any other network that we could tap into. And so it really helped us sort of bring the diversity of their networks into our community at First Round.
The next step for the Angels, pushing startups to disclose the diversity of their cap tables.
Understanding what percentage of the cap table do women and underrepresented minorities own is going to be a watershed moment in the industry, just as getting the initial diversity reports were.
And in the meantime, the Angels are working to change Silicon Valley's power imbalance by helping executives like Sistani make sure female employees get their fair share.
Those early women who were here have helped not only define our culture and our product and our organization, but they'll also be part of the wealth creation one day should we exit.
For Nightly Business Report, I'm Julia Borston in Los Angeles.
And before we go, here's another look at the day on Wall Street. The Dow soared 346 points, taking it back above 25,000. The Nasdaq gained 51. That's a record. And the S&P 500 added 23. And that will do it tonight for Nightly Business Report. I'm Sue Herrera. Thanks for joining us. We want to remind you that this is the time of year your public television station seeks your support.
I'm Bill Griffith. We do thank you for that support. Have a great evening. Sue and I will see you again tomorrow.
Yep.